Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. No hurry to cut. Bond yields climb after Jerome Powell says the Fed will be patient before lowering borrowing costs. Traders look ahead to today's key data on US inflation. Reeves in the red. The UK's fiscal watchdog downgrades its growth forecast, eating up the Chancellor's borrowing margin and piling pressure on the growth agenda. Plus, a bumper day of earnings from Europe's biggest firms. We'll bring you results from Heineken and interviews with leaders from Siemens Energy and ABN Amro. Well, a very good morning. We kick off the show with breaking earnings from ABN Amro, the Dutch bank, of course. Fourth quarter operating income coming in at €2.24 billion. The estimate was for €2.18 billion, so a beat there. A very much focus on net interest income and the cost outlook. We have the CET1 ratio coming in for the fourth quarter at 14.5%. The estimate was for 14.1%. And profit for the fourth quarter, €397 million, an estimate of €448.5 million. So a miss on profit. The backdrop, of course, is the ECB cutting rates. And we're looking out for a name for the new CEO. Will we get an answer from the CFO, Ferdinand Vaandrager, when we speak to him in about 10 minutes' time? Let's wait for that and switch over to another set of earnings breaking out of the Netherlands. We have Heineken for you as well, the Dutch brewer, of course. Full-year organic beer volumes coming in at 1.6% higher, and the estimate was for 1.39%. So a beat there. Adjusted net revenue at €7.47 billion. The estimate was for €7.53 billion, so a miss there. But Heineken seeing its full-year 2025 adjusted operating profit 4 to 8% of organic growth there. So that is the latest out of Heineken. Of course, earlier in the week we had its Dutch peer Carlsberg beating profit, and we're going to get the results from AB InBev, the world's biggest brewer, on February the 26th. But we'll get a lot more on those numbers from Heineken's CEO at 7:30 a.m. UK time. You don't want to miss that interview. But let's take a look at the broader markets as well now, as we think about how those two stocks will open later in just under 2 hours' time. We have futures pointing higher in Europe, but a flat to the downside stateside as we await that crucial US CPI print, dropping as it does between Jerome Powell's testimony. We've had day one, and if we flip over to the cross-asset picture, you can see the impact on Treasury yields. So a steepening of the curve, yields climbing off the back of the first half, and 4.54% is where we trade currently on Treasuries. The dollar fell, but currently a touch higher. Brent trading at $76 a barrel on this rise in US stockpiles, but we await an OPEC report later in the day. And we've got gold weaker now, but a very volatile session yesterday as traders pass all of the various threats when it comes to tariffs, when it comes to the central banking story. We did have a fresh high on gold yesterday, but 2886 is where we trade on the yellow metal currently. Let's get over now to Asia. Avril Hong on standby for us in Singapore with a look at how tariffs and tech are rippling through those Asian markets. Avril.
Yeah, I think those are the main drivers for Asia today. We saw the benchmark for the region mostly in negative territory amid the caution given some of these hawkish comments from Powell, given tariff uncertainty, clawing back some of those earlier declines in the green now. But I think this is mostly driven by the optimism surrounding Chinese tech names. We are seeing a fair bit of caution. Japan's back from a holiday. The Nikkei looking quite flat. We've also seen the Japanese yen declining for the past three sessions. You get the sense that maybe the rally in the past week had gone too far, too fast. Remember the BOJ's January rate hike? The subtext surrounding that was that it would come in the absence of tariff noise, given the uncertainty. Where does this leave future BOJ rate hikes? But the board, as I say, there's a lot of Chinese tech optimism. The key stock we've been watching today, Alibaba, jumping by the most in September. amid reporting that it's tying up with Apple to offer AI features on iPhones in China and kind of beating out the competition that was previously, according to reports, Baidu. So you can see the stock reaction also doing well in markets today. Tencent, another company seen as a beneficiary of China's AI optimism. Lizzie.
Okay, Avril Hong in Singapore, we thank you for that update on Asia markets. But let's get back to the earnings story. We have earnings dropping from Siemens Energy. First quarter orders coming in at 13.67 billion euros. The estimate was for 12.99 billion euros, so a beat there. First quarter revenue, 8.94 billion euros. The estimate was for 8.45 billion euros. And it says it still sees full-year comparable sales up 8% to 10%. So those are the earnings, given the backdrop as well that these shares have nearly quadrupled in the past year as this boom in AI has driven orders for circuit breakers and transformers to really service new data centres. And at the same time, they've had progress resolving issues at their wind turbine unit. So we'll dig into that more later in the programme. But let's get back to the macro story. As I say, we've got Fed Chair Jerome Powell going to give a second day of testimony today. He's already told Congress that the central bank doesn't need to rush to adjust interest rates, again signalling that officials will be patient before easing further.
With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
Well, let's bring in Bloomberg's Valerie Teitel. Val, we didn't see much of a change to the rate cut bets off the back. Will we see more from day two of his testimony or that CPI print?
Look, Lizzie, he did repeat a lot of the lines that he told us back in his January press conference. So not a lot of new news from Powell, again, reiterating that they want they're in no rush to cut interest rates. He was very often attempted to wade into the politics in that Q&A, but he again pushed back on it, saying that they do not speculate on any of these economic policies coming out of Trump, especially when it comes to the tariffs. He mentioned that it remains to be seen what policies will be implemented. It would be irresponsible to speculate. He went on to say that sometimes tariffs affects the consumer, sometimes they don't. It is too early to tell. He also said that inflation expectations remain well anchored. And to that, guys, we do have inflation hitting the tapes today at 1:30 p.m. UK time. Expectations are for a 0.3 reading when it comes to core CPI for the month of January. That would be an uptick from the December reading of 0.2%. If we flip on and look at my last chart, it's very important to note that we do not want to get these strings of 0.3s. 0.3 takes us farther away from the Fed's 2% annualized CPI target. We are due for a firm reading in this core CPI print with that uptick to 0.3% today.
Bloomberg's Valerie Teitel, we thank you as we look ahead to that second part of Jay Powell's marathon testimony in Congress. But breaking news across the terminal now out of Banco BPM. It has raised its offer for Anima to €7 per share. Anima Holdings in this deal, potentially. We've had Banco BPM announcing its fourth quarter net income of €224.6 million, a long big beat on its estimate of €178.4 million. Fourth quarter revenue, €1.43 billion, a beat on the estimate of €1.36 billion. And just a final one, net interest income, €855.3 million. For fourth quarter, compared to an estimate of €830.7 million. So a beat there as well. But we keep an eye on this offer for Anima at €7 per share. It's a busy day ahead. We've got plenty on the docket. Let's take you through some of what we're watching out for. In terms of oil, we have the OPEC monthly oil report coming up later today. Then at 1:30 p.m. London time, as Val says, we've got that latest US CPI reading out of the States for January. January. And then at 5 p.m. London time, just adding on to what Jay Powell's been saying, we'll hear from Atlanta Fed Raphael Bostic as well. But you can get a roundup of the stories that you need to know to get your day going on today's edition of Daybreak, the newsletter. Terminal subscribers can go to DAYB Go. We've got plenty more coming up on the programme, not least getting into those ABN Amro earnings with the CFO, Ferdinand Vaandrager. Plenty to discuss with him. So that's coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It's 6:12 a.m. here in London, and we have already had earnings out of Dutch bank ABN Amro this morning, reporting operating income for the fourth quarter that beat estimates. Net interest income 1.67 billion euros, beating the estimate of 1.61 billion euros. So just a slight beat, but a miss when it comes to the outlook for net interest income. 6.2 billion euros for 2025 compared to 6.4 billion euros. So let's get into it now with Ferdinand Vaandrager, CFO of ABN Amro, who joins me now. Ferdinand, really great to talk to you this morning. Thank you for being with me.
Thanks for having me.
Please, about this morning net interest income trajectory for this year, given that we've got lower rates from the ECB.
Yeah, thank you. Well, first of all, I think we had a good finish to the year. If you look at our net profit in the fourth quarter of 397 million, and it was supported by, indeed, as you say, a continued high net interest income, but also fees grew strongly across all client segments. Both were up over 10% compared to the comparable period last year. Your question specifically for NII, we ended the year at around 6.5 billion. That was above our earlier announced guidance of 6.4 billion. But clearly, we do expect a lower interest rate to have an impact on our overall outlook for 2025. The reference you were making to the 6.2 billion, that is the lower end of the guidance we provided. We provided a range of between the 6.2 and 6.4 billion.
OK. So at the upper end, you would meet the estimates. Let me just ask you specifically what role Donald Trump's tariffs are going to play in your expectations for the outlook for this year.
Well, clearly, the Dutch economy is an export economy, so clearly the impact of tariffs will have an impact. It's wait and see how fast they will kick in. You might see some front loading in the first half of the year. We also do expect, with the overall introduction of the tariffs, that it might have an overall disinflationary impact for Europe. So, yes, it has an impact, but if I look overall at the Dutch economy, they've shown to be resilient, and it's also still supported by quite strong internal demand, both by government spending as well as an increase in consumer spending.
And where are you up to in terms of deciding on buybacks and how you're going to deal with them this year?
Yes, first of all, we propose a final dividend of 75 cents. So then the total dividend payout will be €1.25 per share for the full year. Last quarter, we said already we will have an evaluation moment on our capital position at Q2, and we'll communicate afterwards. What is very promising, if you look at our overall capital position, our core tier 1 ratio increased by 40 basis points to 14.5%. And also the expectation is of Basel IV, which we will report formally in Q1, will be roughly at the same level. So our evaluation for potential of share buyback will then be based on formally reported Basel IV core tier 1 numbers.
And how much confidence do you have on credit quality going into this year?
Yeah, credit quality. I mean, if you look at the full year, we had an impairment release. So you've seen over the past 3 years almost zero impairments for the bank. So that is evidencing the very strong credit quality of our underlying loan portfolios, and also the result of the strong de-risking we've done over the past few years. We do expect a sort of gradual normalization of impairments, but for 2025, we still expect to end up below our through-the-cycle cost of risk, so that will be below the 15 basis points.
And can we just go a bit more deeply into your cost guidance here? So expenses have risen. This is partly why profits missed estimates. You've got expectations of higher costs, but expecting them to be broadly flat for the year. Just talk us through this, these expectations.
Yeah, number one, the missing cost. I mean, if you look at underlying costs, so excluding one-off incidentals, our overall costs for the full year were in line with guidance of around 5.3 billion. That the second half of the year costs were higher, were as expected. Number one, we increased our collective labor agreement at mid-year, and also you still saw a net inflow of additional FTEs where we were expected to scale up in the second half of the year. We do expect that we've reached the inflection point of new hire, and at the same time we're finalizing some of our more structural regulatory programs. So that's why we're also more confident in the outlook that we can remain underlying a roughly flat cost base going into 2025.
OK, and then, you know, we're expecting you to bring on board a new CEO at the end of April. I wonder if that's still the plan. And given that the Dutch stake is reducing its stake to about 30%, can you just give us more of an idea of the strategy going ahead in 2025 and openness maybe for some potential M&A?
Well, number one, I'm very glad that a new CEO is proposed, but clearly they're pending regulatory approvals. But if regulatory approvals are there, the expectation is that Marguerite will be presented to shareholders at our annual meeting. Number two, you're referencing to the Dutch state. They're indeed reducing their stake further towards around 30%. So they're in the middle of a sell-down program. So that's also evidencing that they are very comfortable with the strategy we have chosen. And then on M&A, we have an organic strategy. But if there are any sort of bolt-on opportunities really fitting our strategy, then we are always reviewing that. And evidence from last year is 2 acquisitions. Number one is Bucks, that is one of the larger neo-brokers in Europe. And number two, a more significant acquisition was Hauck Aufhäuser Lampe in Germany, really propelling us to a solid number 3 position in wealth management in the German market. So these are evidences of bolt-on acquisitions where we can accelerate on our strategy delivery.
OK, really interesting. Just one last thing. Any hints on who the new CEO will be?
Excuse me, sorry?
Any hints on the new CEO?
Any news?
On the new CEO?
Yeah, any news? I referenced already to that. I mean, the expectation is that Marguerite will be presented to the annual general meeting, but clearly everything is all still pending regulatory approvals. But really looking forward, and I think it's also a very good transition. Robert is still there, acting as CEO, so that will be a very proper handover to a next CEO.
OK, Ferdinand Vaandrager, CFO of ABN Amro, we thank you for giving us that deeper dive into your earnings this morning. We are looking at futures pointing highest in Europe. On the Euro Stoxx 50 futures, they're higher 0.2%, flat on the FTSE 100 futures, but pretty flat as well stateside to the downside as we await that CPI print later on. And as traders really wait for a second round of testimony from Jay Powell over in Congress, not really doing much to move Fed bets for this year. Only one cut fully priced for the rest of 2025 as things stand. But will that change after the latest inflation reading later on? We've got plenty more coming up on the programme, so do stay with us. This is Bloomberg. Welcome back. Now, the CEO of IBM has welcomed the disruption caused by Chinese AI startup DeepSeek. Arvind Krishna told us that the reckoning over the costs of developing artificial intelligence models will ultimately help fuel the adoption of the technology.
We've been on this point for a long time that you do not have to spend so much money to get these models. If you're willing to make fit-for-purpose models, we do believe that the cost should be in the millions and not in the hundreds of millions. And so how do you begin to distill models down to smaller sizes, get them unique for a purpose, and then run them at 2 to 3%, so 30 times cheaper than the big models, but as accurate and as good for a domain-specific task.
Do you think that, therefore, there could be a day of reckoning for some of these big tech companies spending billions and tens of billions, even $100 billion on CapEx spending plans these years? That's
probably beyond my ability to compute as a day of reckoning, but I can tell you that we're going to find that the usage is going to explode as the cost comes down. So maybe there's enough quantity increase that all of it maps out in the right way.
Yeah, you've always been a big supporter of open source models. And I just wonder, in the case of DeepSeek, whether that actually served as a reason for the disruption to take place. Would we not have seen a DeepSeek come to the market had there not been open source models?
No, I don't believe so, because there are enough large models that people are building, not in the hundreds, but definitely in the tens. And it's hard to imagine that there's an ecosystem which doesn't have a large model to start from. Look, ideas tend to spread. This has been true for 2,000 years. People have written about this. Once there's an idea, it gets penned down, the idea spreads. Once an idea spreads, smart people everywhere can copy it.
Yeah. Let me ask you a question about regulation. I started off the interview asking you whether innovation can keep up with demand. Do you think regulation is actually keeping up with the innovation that we're seeing in artificial intelligence?
I'll actually go the other way around. Too much regulation early stifles innovation and then doesn't allow those companies and those nations where the regulation is heavy to succeed. We can always look at the example. I think that the EU is very good at lots of things, but sometimes the over-regulation is an inhibitor on innovation. And I think we should balance that.
One of our top interviews, the IBM CEO and Chairman Arvind Krishna speaking to Jumana Basecci at the World Government Summit. Now let's get to some of our other top stories making news this morning. Citadel founder Ken Griffin has criticised President Trump's rhetoric on tariffs, saying it sows mistrust with allies. The comments came after Trump announced 25% tariffs on all steel and aluminium imports yesterday. Speaking at a conference in Miami, Griffin said he wanted to say thank you to Elon Musk, however, for trying to slash government spending. And the US Treasury Secretary Scott Bessent is travelling to Ukraine this week to meet President Volodymyr Zelensky. The pair will discuss US efforts to resolve the war and secure critical access to minerals. Bessent will be the first member of Donald Trump's cabinet to visit the country. So those are some of our top stories this morning. Coming up on the programme, the US and the UK failed to sign the final communique at the Paris AI Summit. We'll bring you all the details of that next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. No hurry to cut. Bond yields climb after Jay Powell says the Fed will be patient before lowering borrowing costs. Traders look ahead to today's key data on US inflation. Reeves in the red. The UK's fiscal watchdog downgrades its growth forecast, eating up the Chancellor's borrowing margin and piling pressure on the growth agenda. Plus, Siemens Energy posts a record €131 billion order backlog and sees booming energy demand driving growth this year. But it's a miss for ABN Amro on higher costs. Well, those are some of our top stories this morning. Checking in on these markets, and as they stand, futures pointing higher in Europe. Lots of those earnings to factor in, but they are flat to the downside in terms of the futures picture on S&P E-minis there. Really traders waiting for this US US CPI print before the second half of Jay Powell's testimony. If we flip over to the cross-asset picture, you can see the yields story. Yields climbing off the back of the first part of what Powell said, the Fed in no rush to cut rates. But the 10-year is currently at 4.54%. The yen kind of suffering from the fears that Japan is going to be whacked by Trump's tariff. It's the worst performing G10 currency this morning, I think, at a 153 handle there. But oil, a touch lower on this rise in US stockpiles. Now we wait for the OPEC report. And we've got gold weaker this morning after a very volatile session yesterday. It did hit a fresh high, but the yellow metal currently trading at $2,889 a troy ounce, weaker 0.3%. Let's get some more breaking earnings this morning out of SoftBank in Tokyo. It was expected to post its second net loss in about a year after these major investments like ARM dipped in the fourth quarter, and we have a net loss of 369.1 billion yen. The estimated loss was 154 billion yen. So a whopping great loss there. Third quarter net sales 1.83 trillion yen. The estimate was for 1.84 trillion yen. Investors very much focused on how SoftBank plans to fund Stargate. Don't forget this AI venture with OpenAI. Remember, just a few weeks ago, the founder Masayoshi Son stood alongside Donald Trump to unveil that project. There are worries about his propensity, shall we say, for the big bet the house deals, and you would think it would be a bit awkward maybe behind the scenes of Stargate after Elon Musk's offer for OpenAI, and CEO Sam Altman telling our very own Tom McKenzie that Musk's whole life is probably lived from a position of insecurity. An interesting interview there with our very own Tom McKenzie, and speaking of whom, let's go to him in Paris, where the UK and the US were among the countries that did not sign that final statement from the AI summit, which called for promoting international governance over artificial intelligence. American Vice President J.D. Vance used his speech at the summit in Paris to warn strongly against overregulation in AI.
We need international regulatory regimes that fosters the creation of AI technology rather than strangles it. And we need our European friends in particular to look to this new frontier with optimism rather than trepidation.
Well, let's get more from Tom McKenzie on the ground for us in Paris at the AI summit yesterday. Tom, what was the sticking point in this final communique?
Well, look, 60 countries and organisations signed on to the final communique. Both the US and the UK say they're going to continue to work at an international level on AI and that they work closely with the French through the summit. But absolutely, it was a headline when it was announced that UK and US had basically stepped away from signing off on the final communique. Neither country wanted to sign off on the final communique, ultimately out of the AI Action Summit here in Paris. They both had slightly different reasons. The UK said that the language, they were concerned about the language within the communique, particularly when it comes to opportunity and national security. They said it didn't address some of the harder questions around national security, and it also didn't give some practical responses to global governance. Those were some of the key concerns from the UK. When it comes to the US, interestingly, they said that there was too much focus, or they were concerned about the language around sustainable and inclusive AI. The communique put out, and again, signed by 60 nations and organisations, included a focus and a list of priorities on ethical AI, on sustainable AI, on open and transparent AI. Countries like China and India signed up. The US wasn't comfortable on the language around transparency or around sustainability and inclusivity. The UK less comfortable with the language on global governance and national security.
OK, so that's the kind of international relations picture when it comes to AI. But, Tom, you've been having some juicy conversations, haven't you, when it comes to the corporate drama? What else has been discussed at this summit?
Well, top of mind amongst executives that we were speaking to prior, of course, to Musk coming through with that bid, $97 billion for Sam Altman's OpenAI, was the question of DeepSeek and Chinese innovation. And that was certainly top of the list for many executives that we spoke to. None of them really saw this as a major game changer when it comes to changing the spend on the hardware, on the chips and the data centers. At least that wasn't a consensus that we got. We got split opinions about to what extent this was going to impact the development of AI going forward. Demis Hassabis of Google DeepMind said he did not see it as a silver bullet in terms of changing the efficiency curve. But Arthur Monch, the CEO of Mistral, based here in France, which builds out these foundation models, said it was very positive for those companies and startups focused on open AI rather than closed models, open models versus closed models. So that was DeepSeek, that was part of the conversation. But then, yes, of course, we got that offer from Musk. And then, of course, we had that sit down with Sam Altman and the response. And that's when it took a personal twist. Take a listen to what Altman had to say about Musk himself.
Probably his whole life is from a position of insecurity. I feel for the guy.
You feel for him?
I do, actually. I don't think he's like a happy person. I do feel for him.
So yes, it is getting personal between these two billionaires, Sam Altman, of course, the CEO of OpenAI, and Elon Musk. And to some extent, the debate between these two distills a broader debate that's happening within artificial intelligence. It's about who controls this technology that many expect to be revolutionary, of course, in terms of the impacts on society and on businesses. Who controls it and how is it shaped? And to some extent, the feud between Musk and Sam Altman is indicative and is a signal and symbolic of the broader tensions amongst startups, but also amongst nation states. The sovereignty question was primary as well here at the AI Action Summit in Paris.
Tom, it's been amazing coverage. We thank you. Out of Paris, bringing us all the personalities behind the tech drama. Now, we're going to get the fourth quarter GDP numbers from the UK tomorrow. Economists reckon that output fell 0.1% in the final 3 months of last year, following a stagnant third quarter. And this amid, of course, fallout from the tax-rising budget from Rachel Reeves, leaving Britain back on the brink of recession. To discuss what's happening in the markets, let's speak to Benedicte Lowe, equity derivatives strategist at BNP Paribas Markets 360. She joins me now in studio. Good morning. We've got this story on the terminal. I'm really interested in this because our reporters have kind of got their hands on the OBR's latest estimates for Rachel Reeves's headroom. It looks like they have downgraded growth, just like the BOE did last week. So can I start by asking you, how are you thinking about the UK right now as a place to invest?
Yeah, the UK is a bit of a tricky place at the moment. The growth picture is not amazing. Obviously, we've seen also a weakening of the currency. Everything has begun against the dollar, but specifically the UK, there's been some internal story. The rates part also has made it a much trickier for companies to borrow rates with the rising rate environment. For the equity part, it's actually performed very well. The equity market has been held by performance on financials, has held by the rise in rates environment. But from there, we don't see as much upside for UK stocks. We think that the current environment in terms of growth is not the best for companies to perform super well. We prefer the companies that are more international, such as the FTSE 100, much more than the domestically driven companies, given the state of the economy.
And what have been your takeaways mainly from earnings season so far? Of course, in European banking more broadly, M&A a real theme.
Yeah, I mean, the overall European earnings season has been really strong. It's the best we've had in 2 years. Really, European companies have surprised to the upside. At the moment, we've got around a half of companies that have announced their result, and 80% of them are beating sales expectations. So those are very strong numbers. The financial ones are also very strong. So it's been really helping the performance of European stocks.
When it comes to tariffs, you know, we're trying to look at how equities are reacting. Are they being too complacent?
I think complacency is the word. We've seen very strong outperformance of European stocks over US stocks since early December, and there's some eyebrows that are being raised regarding some complacency on tariff. A lot of positive news now is in the price for European stocks. We remain supportive and constructive on European equities, but we say in the short term, the market's not pricing as much. Some risk around tariff, that will come. The question on tariff for Europe is not a question of if, it's a question of when, and we do expect a bit of pullback on the back of some tariff announcements.
Yeah, I mean, because we've had this retaliation from the EU now. So how do you position around that now we've got a bit more clarity?
Yeah. So obviously there was some quick win for the tariff announced between Canada and Mexico. Our roadmap for Europe and for China is that those easy win will not be the case for Europe and China. We're going to have longer negotiation. The Europe will fight back. There's going to be some countermeasure that we will put, and it's likely to last for longer than it did, say, for Mexico or for Canada last week.
And the other element of insecurity in terms of domestic politics is the German election. How do you see that playing out for equities there?
Yeah, so actually on the German election, not a political expert, but looking at the polls, what we say a union-led grand coalition with the Social Democrat, that should be positive for German equity as a whole. We expect on the back of that some cut in taxes, potential deregulation, also potential boost in investment. And there's also a lot of discussion about the debt brake reform, even if they don't completely overall that, if there's more fiscal stimulus, that should be overall positive for the German economy. Now, in terms of the equity markets, when you look at the DAX performance, stellar performance last year, strong performance this year, basically the DAX are completely decorrelated with the state of the economy. So we don't think it stands to benefit as much from the result of the elections. What stands to benefit most is the mid-cap companies in Germany that have really suffered from the domestic situation. So MDAX is the index that we prefer.
Okay, really interesting. Just finally, if the war in Ukraine does end, how does that play out for stocks? Is it the hit to defence, does that kind of offset, is it offset by the boost to infrastructure when you have kind of war transitioning into reconstruction? Infrastructure,
but also boosting confidence and sentiment. We really see at the moment the balance sheet of the consumer in Europe is quite strong, but it's not leading into higher propensity to consume. If we got the end of the war, that can kind of help sentiment in Europe. There's been an over-bearishness on the region forward, so we tend to think that it's going to be more positive for stocks than negative.
Okay, really interesting. Benedicte Lowe, equity derivative strategist over at BNP Paribas. Good to have you with me around the table this morning. And we're going to be speaking to the Dutch retailer Ahold Delhaize as the company reports fourth quarter earnings. We'll get their guidance for 2025 for the US and Europe, so we'll continue that tariff conversation and the health of the consumer. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It's 6:45 a.m. in London, and we've got breaking news now from the Chinese struggling property giant China Vanke. And the authorities in China, it appears, are working on a proposal to help the company plug a funding gap of about 50 billion yuan this year. So if we look into this plan, regulators would allocate 20 billion yuan of special local government bond quota for the purchase of unsold properties and vacant land from Vanke, and this proposed financial backing really is a further sign, isn't it, that Beijing's drawing a line in the sand for Vanke so that the developer, state-backed as it is, doesn't suffer the same fate as Evergrande and the other private firms, of course, that have defaulted on their debt in recent years. We had the local government of Shenzhen stepping in last month to take management control of Vanke, and so the latest in how the authorities are planning to help the company plug this funding gap. So that is the latest when it comes to China Vanke. CSI 300 currently up 0.9%. The MSCI Asia Pacific Index up 0.25%, and that is the latest out of China. But let's come back to the European earnings story. We have breaking earnings now from Ahold Delhaize, which is, of course, the Dutch retailer. It gets 60% of its revenue from the US, 20% the Netherlands, and the rest of the world, making up 20% extra. And we are seeing that its fourth quarter adjusted operating margin is 4.1%, so bang in line with estimates. And their fourth quarter adjusted operating margin is a slight beat, 4.1% compared to an estimate of 3.97%. US adjusted operating margin, 4.9%. 4.2%, so a slight miss on the estimate of 4.53%. And the outlook for 2025 adjusted operating margin is about 4%. The estimate 3.99%. So again, pretty much bang in line there. Something of a barometer of the consumer is the Dutch retailer, and we can speak now to the CFO, Jolanda Poots-Bijl, who joins me now. Really good to have you with me, Jolanda. I want to just start with Profirom, the Romanian retailer that you recently completed the purchase of. How's that going? Do you have any updates for us on that purchase?
Well, first of all, we're very happy that we closed the transaction with Profi. We have a vision that we need to be number one or number two in the DMAs or markets that we operate in, to have the density to earn enough money to invest in our customers. And in Romania, we had a number 5 or number 6 position. By acquiring Profi, we now have a number 1 or number 2 position in the country. So we're very happy with that transaction and look forward to executing and working together in the next 12 months as a starter.
And that acquisition gives you, as you say, a leading position in the Romanian market. Which other geographies are you maybe interested in taking over for future expansion?
Well, we always have a keen eye on M&A, but our hurdle rates are quite, one could say, conservative. In our business, we have very low margins, as you know. So we need to be pretty sure that an acquisition is strategic, a strategic fit in our portfolio and meet those hurdle rates. So an open eye, but not any active plans at this point in time. And you refer to Romania, why it was such a brilliant fit, I would say. We were very large in the center of the country, and we now, with Profi, added the rural sides of the country. So that fit is quite unique. And like I said, it fits that number 1, number 2 position. We're doubling the total size of our activities in Romania by this combination. So we're welcoming Profi as our 17th great local brand to the family.
So maybe no details on particular M&A, but do you think it would be more likely to be in the US or Europe if you're scouting around for what you might do?
You know, for us, we have 2 regions, big regions, as you said, Europe and the US. So we're open to opportunities in both areas. At this point in time, if I look at our Growing Together strategy, which we kicked off in May, if I look at the US, we are investing in a 1,000 stores openings and remodels in the next 4 years. So the first focus is organic growth. You know, to earn money in our sector, it's about densifying what you have, finding adjacencies, growing the brand strength that we have, and only after that, it's the M&A activities, which is always a bit more complicated in our industry.
And perhaps more complicated, shall we say, by the return of Donald Trump to the White House. How are you thinking about the impact of tariffs and geopolitical uncertainty on your business?
Well, you know, society and also our brands profit, of course, from a stable world at large. If we look at current developments in the US, for example, around tariffs, we're very lucky that we have local businesses. So, you know, more than 95% of our US businesses are sourced locally. So we're monitoring the developments, of course, with great interest and closely. But our first assessment is that both our businesses in Europe and in the US are sourced locally, so not directly impacted. Indirectly, of course, for us, it's important that customers have enough spending power because that benefits our business and our customers.
And you're kind of a barometer for the consumer. We've seen food prices on the rise again, issues in the US with specific products. Is there anything that Donald Trump could or should do to bring down grocery prices?
Well, we're not advising the president of this, but we think it's really important for society, for our customers, that inflation is moderate. So that would be something to be very careful of for all of us. We do see that our customers in the last few years are very focused on value. That's why we have a big price investment program in the US. For example, we announced that we will invest $1 billion in the next 4 years in our prices to ensure that, you know, groceries stay affordable. So it is a topic and it is very important. I think in our strategy, it's the center point, providing affordable, healthy food, investing in prices. And the next big topic for us in that area is our own brand strategy. So we are focusing to increase the own brand products, the assortments that we have. And those own branded products have high quality products at affordable prices. So one could say that delivering value to our customers is central, and everything a government can do to ensure that inflation doesn't peak helps our customers and helps us.
I'm sure he's listening. Jolanda Poots-Bijl, thank you so much. CFO of Ahold Delhaize. Great to have you with me on Daybreak after your results this morning. We've got plenty more coming up on the programme, so do stay with us. This is Bloomberg.
Donald Trump needs to settle down and focus on what he ran for president on, and that is lowering costs for American families. That's where he needs to keep his attention, and that will put the Fed in a much better place to lower interest rates.
Massachusetts Democratic Senator Elizabeth Warren there with an admonishment to Donald Trump, sort of echoing what we just heard from Jolanda Poots-Bijl on inflation. And indeed, we've also heard from Jay Powell, the Fed chair, in the first half of his testimony to Congress, pretty much saying that the Fed can wait and see what happens given the resilience in the US economy. And you can see that the Fed bets for the year ahead pretty much unchanged off the back. Still pricing 1 to 2 Fed cuts, only one fully priced at this point. But if we flip the board over, we've got more Fed speak to come, of course, not just from Powell, but also from Raphael Bostic. And at the moment, our economists think that the Fed sentiment is staying hawkish. So we'll keep across the second half of that testimony as we get the US CPI print as well, halfway through this testimony to digest. But we'll get back to the earnings picture as well. We've already had a raft of earnings. The Heineken CEO is going to be joining us at 7:30 a.m. UK time to discuss their latest results. We're also going to be speaking to UniCredit CEO Andrea Orcel at 9 a.m. London time. A lot to talk about when it comes to the M&A story here in European banking. But that does it for Daybreak Europe. The opening trade's coming up next. Anna Critty and Guy will take you all the way to the open. This is Bloomberg.